Hello everyone and welcome to Step Into My Office, Commercial Property Executives podcast series that tackles all things office and flex office related. Join me and industry experts in the field as we take some trips across major markets and delve into investment strategies and opportunities in the sector. I'm Olivia Bunescu, Senior Associate Editor, and for this episode, we'll take a closer look at Dallas's office dynamics. Although some of the fundamentals like vacancy rate remain concerning, others seem to outperform the national average. So what makes this market shine and how is it different from other metros? Follow me and Newmark's Head of Southeast Research, Ching-ting Wang, and the firm's Executive Managing Director of Global Research, David Bitner, as we zoom into Dallas's performance and uncover where it stands compared to national dynamics. Thank you very much for accepting my invitation to Step Into My Office, CP's podcast series on all things office related. Today we're going to discuss the Dallas market and we'll touch a bit on the dynamics, some challenges that you're noticing, as well as some perspectives and some of your predictions for the sector and the flex office market. So I will start with the first question. How would you describe the current office fundamentals in Dallas? Is there something brokers are keeping an eye out for in the market?
Yeah, definitely. So I think we'll start with the fundamentals first on our end. In terms of fundamentals wise, for second quarter of 2025, we did have positive absorption. It was around 36,000 square feet and such. So far this year, it's been at 165,000 square feet. So we are more positive this year versus like where we were at last year. So basically the same time frame, like the first two quarters of 2024, we were at negative, around 400,000 square feet. So fundamentals have improved in the market. The only thing is that we still have that supply and demand slight imbalance, which has pushed our vacancy up to a historical high in our market. But again, I think one thing to remember for vacancy in Dallas is that we tend to like building new buildings out here. So there is a fundamental side for vacancy where you do have a lot of vacant, obsolete buildings that are part of that inventory pushing up that vacancy. So although that is a historical high, that is something we also have to remember that is nuanced to, say, Dallas in particular. In terms of, I would say, for leasing activity overall for the market, there are still deals being done. We're over 3 million square feet of leases signed for the quarter. But one thing to remember is that the number of deals as well as the deal sizes are a lot smaller now. So that is definitely pushing down the amount of quote unquote leasing activity that we're seeing because there's less deals done, but also the deals that are being done are also smaller. The flip side is that for Class A office space, the deals are larger in comparison. So that is where the demand is at because you are still getting a lot more demand for larger spaces than Class A versus just overall market. I want to say in terms of things to keep a lookout for is that, again, like what we mentioned, Class A space, quality, high quality space is something we want to keep on looking out for because that is still a trend in the market. The other thing is that the evolution of how people are working would be one thing. So I know in the past, like post-pandemic wise, people talked more about, say, return to office. And now it's more of like, how are they working in the office? Like, what are people's preferences? Workplace strategy would be a big one to be on the lookout for on that side as well. And then the other side of things would be more of like the grander scheme of skills, like I would say on the national scale, where you have the economic policies as well as like impacts on the national scale that will trickle down to more of, say, the local level in that regard. So like, for instance, one thing is like with the tariffs and whatnot, right? That push potentially construction costs up in a sense, but how that trickle effect will come down into Dallas is something that is to be seen. But I know on our Newmark property management side of the business, I know they are looking at about 5 to 7% increase in construction costs forecasted for the rest of this year. So that would be definitely some things we want to be on the lookout for in the market.
Mm-hmm. And can you touch on some of the submarkets in the metro that are proving more resilient than others, mirroring these fundamentals that you've just mentioned? And what are some factors driving that performance?
So I would say the Uptown Turtle Creek submarket is definitely one that tends to stick out for us quite a bit. It is a very, first off, established submarket on our side. It is a relatively urban area, so it's just north of our downtown Dallas CBD. So you have a lot of new buildings, modern buildings that are being built. You have a lot of strong workforce out in the area. And also you have the density. So that way you have more walkability in the area. Part of that is something that is driving growth in this pocket in particular, because you have a lot of these high-rise modern office buildings, the trophy assets, so to speak, that have people preferring this pocket of town versus, say, a different part of town. I would say the other thing is that there is a lot of construction out here in Uptown Turtle Creek as well. And it is also where a lot of these firms, especially in the financial side, consulting side, want to be at. So like, for instance, when we look outside of our window here at Newmark, we actually see across the street to the new Goldman Sachs building being built. So they're actually building a new campus out here. You have a lot of financial companies out here in Dallas in general, and they are definitely going to be setting up a Y'all Street, which is the different side of Wall Street out here, especially with the new moves from the Texas Stock Exchange as well as NASDAQ to the greater market area. The other submarket I would say that sticks out to me would be the Legacy Frisco submarket. This one isn't as urban as, say, Uptown. It's further north of our market. So it's what we would call it more of a suburban submarket. But we do still have high rises out there. And a lot of the concentration out there is you have a lot of like residential pockets out in that area. So you have a really strong residential base. It's further north of the city, but a lot of people live out there, so it's an easier commute for them. And relatively rents are also cheaper out there as well too, but you get a lot of these nice modern buildings with tenants who want to be close to both live, work, play. And I would probably say that segues nicely into the winning office piece that David, you can also speak on too.
Yeah.
Yeah, I mean, I think it touches on this. A big theme in the market has just been equality. It's all about trophy office. And to be clear, we do see outperformance in trophy office. But what we've really found is it's a cross section of these dynamic submarkets with building quality. And so earlier in the year, we put together a great report on this, and it highlights markets like Turtle Creek and Legacy Frisco as the Dallas examples. We also profile other cities to identify what are their top performing submarkets that are very mature, like Turtle Creek, or are emerging. And what we're looking for in determining those is how many Fortune 500 occupiers are there? How long has that been like a real center of business and performance? Versus emerging, where we're really looking for where inventory exploded and with it, that absorption and leasing activity. We see these dynamics and changing. You mentioned live, work, play. We really are strong believers that stronger submarkets tend to have a more balanced mix between the office, residential, and experiential retail component. We think this is a consistent factor across a lot of markets. Obviously, physical safety and aesthetics is another factor there, as well as the transit. You said before, you could have a market that has all these attributes, but if the labor isn't able to get there, then you're going to have issues, which is part of why having a residential component is important, because you're able to co-locate talent with the needs.
Mm-hmm. And since we got into the discussion of equality, could you touch a bit on the flight to quality trend in the office sector? What are tenants looking for nowadays, the main characteristics they're looking for, the amenities, and specifically for you, Ching-ting, I hope I'm pronouncing your name right.
No, 100%.
How is that reflected in the Dallas market? And also, David, you can come in with a national perspective.
Yeah, so I think fundamentally, flight to quality, there is a reason why Uptown is one of our outperformers, because you have that density. So you have that walkability. It's basically something that we call almost our new CBD in a way, because it's like our CBD, but it's newer and it's actually just north of our CBD. So it has a lot of the amenities that people want that is traditional to a CBD, but in a newer area. I would say, given that it is also Texas for Dallas on this side, ease of access is also a huge thing as well too. So if you're in Uptown, that would be more of, hey, I want to be able to walk to places. So once I walk outside my office building, can I walk to lunch? Can I walk to a client meeting with all the synergies around here? But if I'm in more of a suburban submarket here in Dallas, the ease of access is also a huge thing because we do have a lot of office parks, but everyone's driving in and out. So if you only have that one entrance in, one entrance out, people really don't want to work in an office park where it takes them like 15 minutes just to get outside of the office park to start driving home. So that ease of accessibility.
All simulators. That's not what's bringing them in. You got to be able to park your car.
Exactly. Parking is also a big thing as well too. Once I get in, can I park my car? Do I have a parking space? But I would say ease of access is definitely a huge one. And then the other one would be just synergy. So a lot of companies like being next to each other because A, their clients might be in that area. It's easier to meet with other people who are in that same industry to maybe talk and share ideas, go to meetings and whatnot. So there is that consolidation of different types of industries in certain pockets. That's why we see more financial firms together in the same parts of town mostly, or consulting firms, or even law firms as well. And then it's just the ease of getting around everywhere. Meetings, if people need to run errands during the workday, do I have a place that I can run to pick up a little bit of lunch or whatnot, or go to the gym after work? So there's a lot of synergy in those types of things that people are looking for when they're looking for quality.
David, is there anything you'd like to
Yeah,
add?
one kind of dimension I'd add to that is like all through the post-pandemic market, you've really seen this traditional segmentation even more clearly between cost-oriented office tenants and quality-oriented office tenants. And sitting behind that is also the quality-oriented office tenants tend to, in general, it's a little weird with some tech companies, but they also tend to be more focused on front of office, client engagement, things that benefit from the synergy of co-location. And so we've seen that's the area where there's been the most resilient demand. This is consistent with the general observation that Class A space might be 34% of national inventory, but it counts for 50+% of leasing. And it's where net absorption has been better. It's where there's better rent dynamics. And it's because you have these tenants who are like, I need to create a really compelling environment for my earners. And so they're less price sensitive. They're willing to pay up. We have an interesting analysis that we did in our last house view report for office, and it'll be updated for this one. So go out and read it in a couple of weeks. We're asking rents over time, going back to around 2000. And we looked at the revenue of office using industries using our proprietary weights. I just got to tell you, office using companies have grown their revenues a lot more than rents have gone up. A lot more. Like cumulatively, like our index started at 100, now it's at 64. So I think this is relevant because it means that you have these quality-oriented firms. They're very price insensitive, relatively speaking, to getting the space that they need to action their business. Now, on the other side of that, yes, you're thinking about like a local CPA. And I think this is interesting because like when we look at the data, Trophy is doing well, particularly in these dynamic submarkets we talked about. And Class B has surprisingly held up. Like in most markets, you look at Class B availability, it's either lower or the same as higher grades of property. It's really commodity A that's gotten beaten up on because it's lost between these two profiles. We're starting to see that change in submarkets. Like Manhattan's a great example of where the Trophy is just full. So the strength is percolating down into the commodity A's. But I think it's important to provide that overall context to the Trophy narrative, which is that there's a whole another market that entails a different profile of user and a different profile of asset quality.
All right, thank you. I wanted to discuss a bit about, even though fundamentals, and this is referring to Dallas as well as other markets, seem to be pretty okay and strong in certain markets, including Dallas. The office sector still lags behind. This is the national trend. What do you believe is missing from the office recovery right now, both in the metro and nationally?
So I would say metro-wise for Dallas, it depends on how you slice the story, and that goes back to what David had mentioned to an extent as well too. We talked about second quarter net absorption being around 36,000 square feet positive and 165,000 for the year so far. But if we're looking at, say, just Class A in that regard for this market, the numbers bump up significantly. So if you're looking at the first half of this year for just Class A, it's at 1.2 million square feet. And that's a huge gap compared to just looking at the market as a whole. So I think fundamentally, it depends on how we slice the market in a sense. If you aggregate all the numbers, when you have a lot of these other buildings in it, it might not look like it's doing as great overall. But if you're actually looking at the true performers in the market, it is actually doing well. And the fundamentals, like such as population, employment, so on and so forth, is supporting that side of the story.
All right.
Yeah, I think that's an important point because I would make the argument that if we look at just all of office holistically, it's going to take a long time for those statistics to look good on pre-pandemic terms. Part of that is because many markets are now experiencing things that places like Phoenix and Houston or even parts of Dallas have experienced historically, where you just have obsolescent product that's still in the statistics, but is not competitive. And therefore, if you look at your overall availability rate or your vacancy rate, it's not actually going to be very meaningful in terms of thinking about how rents are going to change. And so I think for the foreseeable future, we're going to be needing to be more analytical and precise on talking about trends within segments of the market. Now another factor is that we do still have aftershocks from the pandemic in terms of portfolio adjustment. We've been tracking this for a while. As of current quarter, about half of all the leases that were in place in 2019 haven't rolled yet. Now, we've had job growth in the interim, which can backfill that, but we know from the COVID shock that there was a change in office requirements per person. The smaller lease sizes that we're seeing in Dallas and also across the nation on average compared to is another kind of support effect. The more job growth we have, the more that it's offset by new incremental demand, the more people come back into the office. There's multiple factors that can close this gap, but it's still something we have to cover. And my base case for the office market has been stabilization and then a very gradual recovery overall. And then there'll be pockets of stronger, more explosive performance. So for example, like we're seeing CBD markets across the country outperforming the suburbs increasingly from a leasing perspective, which was not true immediately after the pandemic, but it's coming through now. It's coming clearer in the data. We've seen leasing activity pick up overall, especially Class A properties. It's hit a new steady state. It's below where it was, but it's just going to be a matter of time. And from an investor perspective, it's going to be about identifying these pockets of fundamental outperformance if you're looking for core, or potentially looking where the puck's going next from a more value add perspective.
And since you touched a bit on leasing and the analytical side of things, I wanted to know if landlords are rethinking their leasing strategies or still holding out for previous leasing dynamics. I've heard some experts, both in interviews and the podcast, saying that most landlords are rethinking their portfolio and right-sizing their portfolios. What is your take on that?
So I would say on the leasing side of things, a lot of it drills down to the quality of the assets as well too, because at the end of the day, they need to make sure their asset is marketable and people want to be there, like they can attract tenants. And that strategy can vary depending on the asset type. So if you have a prime trophy asset, the strategy will be completely different if you have minus type of assets. So it is definitely driven quite a bit by tenant need and what the tenants want. We are seeing tenants tend to look at more of having efficiency for their workers. So whether it is making their floor plates more efficient across the board, or having more efficient space where their workers can come in, get the job done, and also having those amenities around the area. So that way things can run more smoothly, things can be more efficient across the board. And so I think there is a lot of that aspect on various levels that people are looking at and driving that efficiency when they're looking at leasing strategy.
Yeah. I think it's a little amorphous thing, like going back to pre-pandemic leasing expectations. I think one of the things that's been problematic for many landlords is that market TIs have gotten so high that it pretty severely can cash flow in the front years of a lease. And that complicates the calculation of whether that lease is actually accretive to the landlord. So I think there have been just some failures of the market to clear as a result of that. I think it's very notable that nominal asking rents have not really come down much. They've been basically flat nationally. There's markets like San Francisco where there was an adjustment, but overall, it should be shocking that vacancy can double and then rent flat. And I think we've given some explanations, like inflation's a factor of that. Real rents are way down. We've said that the revenues that's gone up. These are some compensating factors, but it still doesn't overturn this idea that we should have seen more adjustment in base rates compared to just through TIs. And I think there's some perverse dynamics with that that relate to debt sustainability, cash flows for debt payments. I think lenders get involved into these decisions. And I would have expected more movement. This is a theme that we've been talking about for a couple of years, but we haven't seen it significantly ameliorated yet. And that's partly because the distress cycle has just continued in a wait and see mode and years now. And this is another factor that's going to lead to a slower office recovery, although potentially this reduces the volatility that we see in the rent series. The one other thing I think might be interesting is we just passed a big tax bill, or the country did. And there's some really interesting provisions in there around immediate expensing, 100% bonus depreciation that include a lot of property and internal building improvements, provided they have a depreciable life of 20 years or less. Look, I'm not a tax lawyer. I don't even play one on TV. But it's piqued my interest on whether you might see landlords wanting to take over improvements themselves so that they can deduct them 100% in year one. And I'm just like, this could be cool. I had a long conversation with Grok about it. We both agreed that it was a very interesting thing, and on paper, it seems like a thing that could be done. I think it's, as best I can tell, like it did not happen to any meaningful extent in the years following the Tax Cuts and Jobs Act. Leaven your expectations there, but they also seems to have made a lot of these interest deductions more holistic. And they adjusted some of the text from before. There were errors and omissions there. But at a minimum, like, there's going to be investors and landlords out there listening to this call. And I'm like, you might want to look at that. You might want to talk about that. Maybe that's a thing. Maybe it started here. Maybe we are the grain of sand that crystallizes this in the market.
I guess we'll have to go back to the wait and see. I have a specific question about development in Dallas, because there is currently 2.8 million square feet of office space under construction, despite the vacancy rate. What's fueling that pipeline and attracting developers?
Yeah, so I would say in terms of Texas, it's always bigger out here. So I think I'm going to set the stage first on that regard. So when you say 2.8 million square feet under construction, when we look at it nationally, we're ranked #1. And it seems daunting because it's such a large pipeline. And for us in Dallas in particular, we're like, wait, it's not nearly as high as it used to be. So for us, like the benchmark is relative. And when we make the benchmark relative to Dallas in a way, our yearly average for our under construction pipeline is 5.6 million square feet since 2013. So that kind of gives us a feel of, oh, this is lower than before. A bulk of this pipeline is for a lot of the new product, especially tied into the financial companies that are building out here. So for instance, we have Bank of America space, the tower at Parkside being built out here in Uptown. We also have the Goldman Sachs building being built out here as well. Just those two projects alone accounts for 46% of that pipeline. And then when you add on to the other project that we have out here in Uptown, which is 23 Springs, that bolsters the pipeline up to 67%. So you can see a lot of that concentration is in quality assets in Uptown as well as quality assets that are supporting the financial firms that are building out here. And the other thing to note is that even though the pipeline is very large, there is demand for the space, and about, I would say, 73% of the spaces are already pre-leased. So it's not like they're just going to put up a tower and it's going to sit completely vacant and shoot that vacancy up in the market. It is called for and it is leased. It may seem daunting, but it actually, when you look at it and break it down, it actually isn't as much. And that's what's fueling that growth out here, because there is that demand for that space.
Makes sense. I want to touch a bit on the flex market. At the beginning of this year, I wrote an article with our internal data from November that placed Dallas the fifth for co-working space. What kind of tenants is the co-working space attracting in the Dallas market?
So I would say the types of tenants that co-working or flex space is attracting here in Dallas tends to be companies that are located in different parts of town. So Dallas Fort Worth is a very sprawled out metropolitan area. So even if you have an office location here in, say, Dallas CBD or Uptown, you may want a co-working or flex space further out into the suburbs, say like Legacy Frisco, just because it takes so much time to travel from one location to another. So we actually see a lot of these co-working spaces being concentrated more in the suburbs versus urban areas. And then the other side of things is that a lot of times these companies want flexibility with the space that they're leasing. So I would say one big example from earlier this year, WeWork did sign a new lease for about 155,000 square feet. They actually signed that lease from McKesson's building out in Las Colinas. And the reason that they signed this lease was actually not for WeWork themselves. They have a partnership with Amazon because Amazon wanted more flexibility in their commercial real estate space. So WeWork is technically operate on behalf of Amazon, so Amazon can occupy that space and kind of do what they need to do with that space. So we are seeing instances like that in the market where companies need flexibility and they might go through a co-working operator for that support.
What about conversions? Is Dallas experiencing a trend towards converting old buildings, old office inventory?
Yeah, I would say yes, but mostly in Dallas CBD, just because you have that density, you have more of that urban build. And also, like I would say about 35% of the buildings in Dallas CBD were built in the 1980s. So you have a little bit more of that older product as well in order for conversions to happen. So for some highlights for the conversion projects that we had, the Sinclair, which used to be Energy Plaza, it's a building that's 1.2 million square feet previously, and now they've converted to both office as well as apartments. Another project was Peridot, and that's in the Santander Tower. And so they converted that one to include apartments, hotels, as well as office as well too. So a lot of these buildings are very large office buildings that they have converted to include some aspect of office, but a lot of it is including residential. I would say one thing highlight, or at least to keep in the back of your mind, is these conversion projects take a lot of money to do. And so there is also that caveat for investors, oh, can this happen? Because we are such an urban sprawled market. It usually typically happens in the very dense urban areas. So for instance, two buildings that were bought out in Fort Worth and also in Fort Worth CBD, they were going to convert it to apartments as well. And those kind of ended up being foreclosed on because you need a lot of capital behind this in order to make these conversions happen.
Yeah.
If we had a more pronounced distress cycle, I would have expected us to have had more conversions and redevelopments. Like, you can look at it. You're like, the vacancy rate is this. We arguably need less office. It should be, you have the whole philosophy, highest, best use, right? A lot of these, you just look at it and you're like, it would be better to have an apartment building there. And then you find out how hard it is to actually make that happen. You might have a building that still is 50% occupied office building. It's not great. Not great for the landlord. May not even have positive NOI. Not sure. They're still there. They would need to be bought out of the lease if you wanted to demolish or completely convert it. If you want to convert it, then like Ching-ting said, it's got to be 70s or 80s build, or basically need to have smaller floor plates and more windows. And then you're still having like really different HVAC and plumbing and everything, and often still suboptimal unit layouts, which if you're in a market where you've had a ton of brand new built to purpose multifamily development, is going to put you in an awkward way unless the location is just superb. So I do think highest best use is mostly going to be through redevelopment rather than conversion, and it's going to take place over a longer period of time. I think we need to see more tax incentives. New York's been out front and offering better tax incentives, and they have more conversions, full stop. Still a relatively small part of the overall inventory, but that's tough. It's a 450 million square foot market. I think we do need to see more foreclosures. We need to see basis on the underperforming buildings go down. Some of that's going to involve going through a lease cycle and the landlord deciding not to renew it. They not want to renew the lease rather than trying to buy it out. I think it's going to play out over a much longer time span than I think many of us would have hoped, or on the kind of news and media report news cycle.
Is the hot topic. Everyone wants to write about conversions. We even have a new segment on conversions, specifically on conversions, and we have assigned writers for that.
You're doing God's work because you're encouraging the market to convert these underperforming properties.
Speaking of hot topics and trends, what emerging trends do you think will define the next chapter of the office market, both in the Dallas metro and nationally?
So I can kick it off with Dallas first on that front. So with the Dallas side, there is a lot of finance companies out here, finance and banking. So I would say that would be a big driver in terms of emerging trends that we are seeing in the market. And also, especially with, say, Goldman Sachs, as well as Bank of America's buildings are going to be built out in 27. So you're going to likely see a shift in the office landscape out here, both on a tenancy side with more banks or synergies to banking and finance on that side moving out here, as well as the landscape just changing in general with a lot more people who are living out here in Uptown or the surrounding areas that work in those industries. I would say the other factor is that as Dallas evolves, I like to make that illusion in terms of Dallas is a younger version of Los Angeles in a way. And so there is a lot of parallels between the two metros, although we are landlocked versus LA having that beach as well as the ocean side. But I would say there is a lot of parallels in that regard. So you have like your Dallas CBD, you have your Los Angeles CBD, whereas the older products in the two markets. You have your new up and coming, like new modern buildings where there's more office demand here in Uptown, whereas you have that in Century City in Los Angeles. But then you can't forget it's both urban sprawl in both markets. So in Dallas, we have Legacy Frisco further up north, more on the other side of town. Whereas like Los Angeles has Orange County. So there's more of that side of town for them and building more office. And then again, for us, like even for Fort Worth, we have Fort Worth on the west side of Dallas, whereas Los Angeles has San Diego further down south. And it's just that's its own market by itself, but it also plays off of synergies within the greater metro area, given its proximity. And then not speaking office on that front, but industrial, Fort Worth also has Alliance, which is further north of that market, which has a lot of industrial product. And I would say that's also comparable to the Inland Empire in Los Angeles area. I think there's a lot of parallels in that regard in terms of as Dallas emerges or as Dallas grows, it may follow more towards the trends of how Los Angeles has evolved over time in that pocket.
I have my own follow-up question for that, if you'll forgive me, Olivia. Like Dallas has been sprawled for decades as it's grown and it's grown and it's grown. If we make the analogy to Los Angeles, like LA did the same thing 20 years earlier, right? And then it hit some geographic limits. Obviously, the coast was a rather major one. We didn't do much seasteading, as much as libertarians would like. But even into the interior, we hit a wall where there wasn't that much. And then it became more focused. That market became higher barrier. It started looking on more intensive and brownfield growth and redevelopment. Where is Dallas at, if we're continuing the analogy on that time scale?
I would say we're still in the beginning phase on that front. We haven't peaked yet per se in that regard, where you start seeing that plateau before you're like, oh, pricing is really expensive out here yet. But we are seeing, like, for instance, cost of living and cost of doing business kind of inching upwards from year to year in the market. So it's increasing over time. It's getting more and more expensive as we continue building up the metro area, but it still hasn't hit that threshold or that level just yet in the market where it's like that tipping point for us. So I would say we're still in the beginning phases of it, and we're not quite to the tipping point just yet. But I think LA and how LA evolves is something that we could take a look at for Dallas, and whatever they do wrong out there, let's just not do it out here, would be our lesson.
As a Californian, I do not recommend our example across a variety of dimensions.
But David, if we're going back to trends, is there something else you'd like to add? What if you expect anything from the office market nationally? What will the next chapter for office be in your perspective?
I mean, we've talked a little bit about it. The supply pipeline is just disappearing. We went from 130 million square feet under construction to 29 million square feet under construction. Deliveries fall off a cliff next year, and they're already way down. Mm-hmm. So it's going to get a lot more competitive for top quality space and top quality markets. Again, that cross section there. We then think that'll begin percolating down into the commodity Class A space, which, as we've mentioned before, has been pretty beat up on. And this is, every market's going to have a slightly different timing for this, but we think that this is going to be a broader trend. Another thing I'd highlight is just, again, jobs. We have more demand, we need to have more jobs. That's going to be the major driver. I think your strategy should be focused on job growth. And another nuance I introduced that is better leasing activity, particularly out of financial firms. Tech has been somewhat selective. Definitely AI firms are exploding in places like the Bay Area where I'm located. But in other areas, they might be optimizing their spaces. But one thing I think is really interesting, we built our own kind of proprietary office using employment index. Usually people just are like professional and business service, finance and real estate, and information. And then that's office using employment. There are plenty, like Walmart has office space, even if they're not one of those, right? A lot of office space is leased by companies that aren't in those three sectors, which makes them an imperfect heuristic. So we built a more holistic index, and it tells you two things. One is the office jobs recovery was much more similar to the overall jobs recovery, which helps explain why the weird misnomer of why were we having massive negative net absorption employment when hockey stick up just because the finance firms hired people back. The second is that, like the overall employment market, more and more of the office jobs that are being added incrementally are happening in education, healthcare, and government. And that includes both federal and state. Someone else came up with this, Keith Reichert, I'm looking at you. Eds, meds, and feds. This is a slide title in our forthcoming report. You heard it here first. And so I think that's really interesting. It worries me because that's not necessarily, as a professional service firm, we would like to see the most growth. But it helps explain why is medical office held up relatively better. A lot of those tenants have historically been very cost conscious rather than quality seeking. Some of that stuff is happening more on owner occupied stock rather than in the transacted market. So one of the things that we need to see is, can those more traditional industries that are more quality oriented, do they return to more robust growth? Because that's going to be important for the higher quality properties, the higher price points, and basically like the non-owner occupied market.
All right. Thank you. That was the last question because we touched on many other things besides the questions I asked. If there is anything else you'd like to add or ask me before we end this podcast episode, please let me know.
Can we come back?
Of course you can.
We had a lot of fun. Well, thank you for having us.
Yes.
Thank you for accepting my invitation. Thank you for stepping into our office. Stay tuned for the next episode of our series in September, and feel free to rate this one if you've enjoyed it. For more commercial news, trend stories, and podcast episodes, visit cpexecutive.com. Have a great day, and we can't wait to see you on our next episode.